Eventually, most investors will want to foray into individual stocks. Here are the 5 key ratios you'll need to get started analyzing stocks. Once you get an understanding of these, you're off to the races. Number 1, price to earnings ratio, also known as PE ratio. The PE ratio is simply a way to determine whether a stock is cheap or expensive. Typically, the higher the ratio, the more expensive a stock is, and a lower ratio might mean it's a good time to buy a stock. It's probably fairly priced or cheap. However, you cannot in isolation decide whether a PE ratio is high or low. So the trick is to compare the PE ratio of a stock with other companies in the sector. So that's the PE ratio. Number 2, the payout ratio. This is the dividend amount you get as a percentage of a company's profits or a company's earnings. It's the way to determine dividend sustainability and growth of a dividend-paying stock. So if a company earns $2 per share and pays out $1 per share, then it has a payout ratio of 50%. Generally, the lower a payout ratio, the more sustainable the dividend payment of a company is. A low payout ratio is a good thing because that indicates there is room for continued growth in dividend payments into the future. The third ratio, dividend yield. A yield is simply a return on investment expressed as a percentage. So a dividend yield tells you how much passive income you can expect to earn on your investment in a stock. Generally, a higher yield, the more the passive income you'll receive in the form of dividends. But do not get fooled and get caught in a yield trap. Do not chase after high yields because oftentimes they are a screen for poor financial health of a company. So be very wary of yield traps. Fourth, the expense ratio. This will help you determine how much it will cost you to invest in a stock, an index fund, or an ETF. Now, because index funds and ETFs are typically based on a fixed formula, they tend to be less expensive. So they tend to have very low expense ratios. An ETF that has an expense ratio of 0.03% means that it will cost you 30 cents for every $1,000 you invest in that ETF. So watch out for expense ratios when selecting or picking stocks. The higher the expense ratio, the more it will cost you and reduce how much of your gain you get to keep. Last but not least, free cash flow or liquidity. This number tells you of a company's ability to meet its short-term financial obligations as they come due. It tells you of a company's financial health. A company that's not able to meet its short-term obligations should be a red flag. As always, this is not financial or investment advice. But now, you're better equipped to start your stock analysis.